overall, the S&P 500 continues to look very strong, making new all-time highs, and our real focus in today's episode is going to take a look at companies that pay very nice yields and are under $50 for those that prefer to buy stocks as opposed to high-value stocks and then fractional shares. The first one is going to be the real estate investment trust Vici Properties. We get a strong buy from Quant, a double buy from both Seeking Alpha and Wall Street. We also note it does pay a quarterly dividend of 5.21%, and in terms of the P to FFO right now 12.7, and we can see trading at the upper end of the 52-week range. Now, if you've been a shareholder over the last 12 months, you would be up around 15.5%. Over the last 5 years, we can see up around 43. Remember, this doesn't include dividends reinvested, so you would be up marginally higher if you continue to reinvest. Out of the next 4 quarters, they are expecting 2 of them to be an increase on a year-on-year basis. The next quarter, they are expecting massive growth of 22%, and when we look back to the last 4 quarters, we can in fact see they have outperformed in 2, but they have also missed, so giving them a 50% track record. Now, they are still anticipating over the next full year for an increase to the FFO, funds from operations, which will ultimately lower that forward P to FFO to 12.27. Now, for each one, we'll have a very quick look at these high-level metrics. They do have a dividend safety score of 50, indicating borderline safe, but when we have come to analyze this on more in-depth detail, the issue with this company is that they do have a high debt level, but overall with their long-term vision, they are expecting this debt to come down over the next few years. So we also hold this in our own portfolio and don't envision there to be any challenges moving forwards. In terms of the dividend yield, we can see based on dividend yield theory an undervaluation sign. Current yield does sit higher than the 5-year rolling. Based on the P to FFO, we can see it is towards the mid to low end, therefore reasonable valuation. And in fact, they did increase the dividend in September this year at 4.2%, which isn't too bad. They're keeping it up in line with inflation whilst also getting a yield of 5.21%. Now, for each one of these stocks, we will look at the valuation model, and for Vici Properties, we got just under $40. Now, we're not going to go through the inputs and the outputs, but when we do our deeper dives, we do look at every single model in detail. For today, we're going to get straight to it. $40, as we said, intrinsic value. Current price around $33, and what we always like to do on this channel is have a margin of safety. Now, we execute on 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, well, in today's episode, a buy up to $36. Then we keep going till it's near the current trading price, and it's not at a 20% MOS just yet, around the $32 mark. But if you are buying Vici Properties, and one that we do hold in our own portfolio, right now you're getting a 15% MOS, with Wall Street, as we can see, indicating 12% upside, which is nice to note, although you could argue when you invest in REITs or high yield companies, you are doing it for that yield, which is very attractive at the current moment above 5%, and also nice to see 12% upside from their Wall Street and their targets. As always, give us your thoughts as we go across these 8 stocks today. We also want to let you know we have released our latest free weekly article where we deliver one to your inbox every single Monday morning, talking about undervalued stocks that we believe deserve your attention, as well as what's gone on in the market over the last few days. So do click on the pinned comment below where you can start reading straight away. You will also be able to gain access to our 36 undervalued stocks for the month of October, where we run through every single one, talk about the upside that Wall Street themselves see, as well as flagging those that sit within our own portfolio. On top of that, you can also grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So as we said, click on the pinned comment below, sign up, and you can read straight away. We then move on to the pharmaceutical giant Pfizer, where we get a double buy with a hold from Quant. It's trading around the midpoint of the 52-week range. Another nice forward yield of 5.75%. A forward P sitting around 11. For context, S&P right now around 25. Over the last year, not the greatest performance, down 7%. Over the last 10 years, it does look very flat, and we can see it pretty much peak during the end of the pandemic, around the $59 mark. Ever since then, though, as we can see, it has been downward trending. Now, in terms of looking at the earnings expectations, well, it does look mixed over the next 4 quarters, but always great to see, and by quite some nice margin, they have historically, over the last 4 quarters, outperformed analyst targets, and they do anticipate an increase to the December 2025 EPS, lowering that forward PE to 10.13. Now we get a safe dividend score at 75, a massive undervaluation signal based on the yield, and whilst we get a reasonable valuation here, we can see it is right towards the lower end, indicating some possibility of undervaluation. We have to be honest, we didn't really like that dividend increase in December last year, given the fact it was below the 4% inflation. We are hoping this December we see, at a bare minimum, that 4% rate. In terms of the intrinsic value for Pfizer today, we get $38, and as we can see, this will give a nice MOS. At 10% a buy at $34, at 15% at 32, and we keep going. And in today's episode, you aren't getting a 25% just yet, sitting somewhere between the 20 to 25% mark. With Wall Street, their expectations are lower. Over the next year, they do anticipate a price target of $33.50 with upside of 15%, which in all honesty, if you are getting a very attractive yield, maybe it is something you are using towards your own expenses outside of investments. This definitely could be one to seriously consider in the portfolio. As always, remember you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's Pfizer or any others. We then move on to the telecoms giant Verizon Communications with a double buy from Seeking Alpha and Wall Street with a hold from Quant. This one is trading towards the upper end of the 52-week range, but with interest rates coming down, we do believe, similar to AT&T, these telecom companies that have high amounts of debt will be able to prosper moving forwards. In terms of the forward yield, we're sitting around 6.2%. Forward PE sitting just below 10. Over the last year, massive outperformance of the S&P, up 42%. Over the last 10 years, though, we can in fact see it is down 10%. Now, over the next 4 quarters, they're anticipating 3 of them to be positive in terms of increases to the EPS. And over the last 4, they've at a bare minimum been in line with management targets. So as we said, a good sign. And they believe EPS growth will continue over the next year, lowering the forward PE to 9.33. We also get a safe score of 70, which is always good to see and key in fact when you have yields above 6%. We also notice undervaluation based on dividend yield theory. We get a reasonable valuation based on the forward PE, but very similar to Pfizer, they have increased that dividend below inflation, which isn't something we do want to see. A little bit disappointing, but again, that is something to consider with companies that do particularly have a high yield. In terms of the valuation, well, our intrinsic value at around $45 does indicate that there is minimal margin of safety. In fact, even at the 5% level, you would have to wait for around $42.50. So we believe in today's episode that this company doesn't have a margin of safety. It is essentially trading at its intrinsic value, although Wall Street believe there's around 9% upside over the next year at $48, and some people may be happy with that as you aren't losing money on your initial investment and you are getting a nice yield with minimal upside. As always though, do give us your thoughts below. We then move on to the oil and gas industry with Suncor Energy with a strong buy from Seeking Alpha, a buy from Wall Street and a hold from Quant. This one is trading in the upper end of the 52-week range, probably the lowest yield we will cover today at 4.04%, and a forward PE sitting just below 11. Over the last 12 months, we're up 13%. Over the last 10 years, up 13%. But again, this will depend at which point you invested. In fact, as we can see at the lower end of 2020, this company was trading at just $11. You would be up nearly 4 times on your investment if that was when you purchased shares. In terms of looking at this company, well, over the next 4 quarters, they're actually anticipating decrease to the EPS. They have outperformed over the last 4 quarters. Important to understand, over the next year, they're anticipating EPS to drop down, and that will increase that forward PE to just below 12. Now, in terms of their dividend safety, it does sit borderline safe at a score of 50. We get reasonable valuation, both based on dividend yield theory as well as the forward PE, and they have increased, although marginally above inflation, the dividend in November last year, meaning over the next few weeks, we are anticipating another increase to Suncor Energy's dividend. In terms of the valuation, well, we believe it is still severely undervalued, and when we run it through the MOS, well, 10% a buy at $47, at 20% a buy at $41, and what we notice in today's episode, if you are buying SU, you are getting a 25% MOS, with Wall Street clearly believing there is still upside, $45 price target with 15% upside. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We then move on to the tobacco giant Ultra Group with just a buy from Seeking Alpha, a double hold from Wall Street and Quant, trading in the mid to upper end of the 52-week range, a forward yield of 8.22%, a forward P below 10. Over the last 12 months, well, up 15%. Over the last 10 years, up really only 4%. Again, even if you did reinvest dividends, it would be higher, but still underperforming the S&P. When we take a look at their earnings though, they are anticipating growth. That is nice to see over the next 4 quarters. However, out of the last 4, they have missed 2 of them, 50% track record. Nonetheless, unlike Suncor, they are anticipating growth over the next full year to the earnings per share, lowering that forward PE to 9.37. Now we do get a borderline safe score of 55, but again, this is one we hold in our own portfolio, and when we've done our deeper dives, there doesn't look to be any reasons why they can't for the foreseeable future continue to pay dividends. We notice reasonable valuation on dividend yield theory, again the same on the forward PE, and what's also nice to note is that this August they increased the dividend in line with inflation, which actually is something we like to see given the fact you're already getting a very attractive starting yield. In terms of the valuation, well, one, we run it through the MOS at 10%, a buy at 51.22, not at 15% quite yet, so we believe up to the 10% MOS point, it is a buy around $51. Again, some people will want a lot more, which is completely understandable in this sector. 15%, well, it's a buy at $48, at 20 around 46, at 25 around 43, and we can see for those that are looking for the 30% margin of safety, a buy around $40, which we have actually seen in 2024. As we said though, 10% MOS with Wall Street indicating $53 price target with upside of 6% over the full year. We then move on to Energy Transfer with a strong buy from Wall Street, a double buy from Seeking Alpha and Quant. It is trading at the upper end of the 52-week range, a forward yield of 7.8%, a forward P of 11.5. Decent performance over the last year, up 18%. Over the last 10 years, however, it is down around 43%. When we take a look, they anticipate 2 of the next 4 quarters to be growth, therefore 2 of the next 4 to be a decrease, and unfortunately one of the poorest in terms of hitting those targets. They have a 25% track record, only outperforming in 1 of the previous 4 quarters. Nonetheless, if you do believe them, they are anticipating growth over the next full year to the EPS, lowering the forward PE to 10.16. We do have a case here of borderline safe on the dividend score with a point of 50. In terms of the dividend yield, we already mentioned very attractive. However, based on the forward PE, there is an overvaluation signal. Disappointing to note that this year they only increased the dividend at 0.8%, significantly lower than inflation. In terms of the valuation though, what we do notice here is that there is a massive undervaluation on that share price. With an MOS at 10%, a buy at $20. At 20%, we can see at 18. At 25, pretty much around the current trading price. So for Energy Transfer, 25% MOS, 22% upside according to Wall Street at the $20 mark. But again, it does pay a nice yield. Something to consider though, whether or not that margin of safety is sufficient to consider in your overall portfolio. We then move on to Enterprise Products Partners, EPD, with a triple buy signal right across the board. Trading at the upper end of the 52-week range, a yield of 7.2%, and with a forward P sitting below 11. Over the last 12 months, well, up 5%. Over the last 10 years, it is down around 25%, but has been upwards trending ever since the drop in 2020, where it was trading at $14. In terms of moving forwards, well, always a good sign, next 4 quarters growth. However, out of the last 4, they did unfortunately miss 2 of them, including the more recent quarter. What we do notice though, earnings per share growth anticipated over the next full year, bringing that forward P to 10.19. We can see a safe score. This is what we really want to see, especially as we said for those that are high yielders. We notice reasonable valuation both on dividend yield theory as well as the forward P, and a fairly admirable 5% increase to the dividend over the last full year. In terms of valuation for this company, well, $33, again, nice MOS at 10%, pretty much where it sits right now, and Wall Street do indicate upside of 20%, which is always great to see, especially for companies that are paying very high yields, because you're getting paid very strong amounts, whilst in fact looking towards a very nice gain. Remember though, these are all just forecasts and you should always do your own due diligence. We then move on to another powerhouse in the tobacco industry, British American Tobacco, BTI, with a buy rating from Seeking Alpha, a double hold from Wall Street and Quant, trading in the midpoint of the 52-week range, a forward yield of 8.62%, a forward P of 7.48, and over the last 12 months, it is up around 14%. Over the last 10 years, though, it is downward trending, negative 37. In terms of the dividend safety, well, it is a borderline safe score at 45, although when we haven't done our deeper dives, there hasn't been any major concerns with them similar to Ultra to be able to continue to pay those dividends. We notice a very nice yield, 8.61%, undervaluation on dividend yield theory, undervaluation on the forward PE, although as we can see, a very mediocre increase to the dividend in February this year. Then when we point out the valuation, our intrinsic value at $47 for a company that does pay a high yield has a nice MOS, 10% at buy at $42, 20% at $37.40, and in today's episode, not quite at the 30% margin of safety just yet, you are getting at least a 25%, with Wall Street, as we can see, indicating 19% upside with their price target of $41. As always, give us your thoughts in the comments below. Are there any of these 8 that you are buying for the yield? Maybe you're looking towards the growth, or maybe there aren't companies that fit within your own overall portfolio. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and jumping into the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.